Good morning. It is May 10th, 2019, and the trade war has begun in full and in earnest, and we will see if I'm right, and there will be positive surprises at some point. So far, hard to tell. So let's talk a little bit about the trade war and what it's going to create. And then I have 3 Trump tariff trades that I will tease a little bit. This chart right here on the front page of what will end up being a report that I put out on Monday night. So all members of Fundamental Trends, of Margin of Safety Investing, and over at FA Trader will get a copy of this report. It'll be released Monday night after the market close. I want to see how the market reacts on Monday. I suspect that that will be the blow-off with a very tradable bottom. Could be Tuesday, but I think Monday makes a lot of sense. Buying orders are drying up a little bit right now in the market, and people are starting to get scared, which is, you know, what happens when folks don't proactively make asset allocation changes. As folks who have been following me know, I actually told folks to get to a more conservative asset allocation back in April. This is the May report, but it's the same information. Talked about a trade war. It's a threat on top of all the other threats. Recession risk is growing. Had a whole host of charts here. You can see these over in the 401k alert section at Fundamental Trends. Talked about the ultimate risks in this market. And we talked about asset allocations for 401k balances, but really this could apply to your entire portfolio. And I was telling people between 45 and 65% cash back in April. I told folks to fade the market rally, right? Talked about how the market was in the middle. And I would have to go into the member content, see if it's available for you. But I did tell people to fade the market. So if you go over to Margin of Safety Investing, which is a little easier to look at, we've got a lot of content here. Selling the market breakout, and anyway, somewhere in there, there's an article that tells you to fade the rally. Anyway, we're going to cover a number of stocks today at the end that we have investments in. We've been getting earnings, cover some strategy, but let's talk about the trade war. And let's talk about this from a more circumspect approach. So, we know that free trade leads to higher GDP growth. And we know that it particularly impacts less developed economies the most. So an economy that is developed and engages in free trade is generally developed because it did engage in free trade. Less developed economies who have some barriers but do engage in free trade tend to grow faster. Why? Simple logic, they're less developed to begin with. So it's just like a small cap growing to a big cap. One of the problems with China is that they want to have some of the benefits of the last 40 years continue. And at this point, actually really the last 47 years, and I'll show you that chart in a moment. And President Trump is pushing back on that. Now, I have questioned whether or not the way that he's pushing back is the right thing, but I have not doubted that the Chinese need to be pushed back on. As you know by now, I'm a little bit hawkish on a lot of international issues with bad actors, right? So if you watch C-SPAN like a nerd, like I do, you will have seen that the Monk debate was on last night, and I don't know if it was a rerun or not. I think it was live. And H.R. McMaster was one of the debaters. It was a Singapore academic, Singaporean. I think that's maybe the right way to say that. A Chinese trade representative, McMaster, and then another ex-U.S. official. And one of the points that McMaster made was that the bottom line is that China cheats. And I don't think anybody really doubts that. So when we talk about Huawei deploying an international surveillance technology, I don't think that anybody should really doubt that that's what's going on. The counterpoint is that we sort of do it with Google and Facebook and things like that. And that's probably true as well. All of these issues that intermix with trade, though, ignore the real point that China probably doesn't need to cheat as much as they used to. And certainly they're starting to realize that. However, President Xi is quite the power-hungry guy. And when a power-hungry guy goes up against a power-hungry guy, there's conflict. And President Trump is a power-hungry guy. President Xi is a power-hungry guy. So the rest of us have to deal with what is going on. And there are definitely some trades to be made. And I'm going to make the argument that things won't get as bad because of trade as many think. That doesn't mean that I think we're going to avoid a recession. I think a lot of things were already on that side, and I think that we will see a recession next year. I think it's almost a certainty at this point, and all of the air that's in the stock market is going to come out. Here's the thing, though. I think there's probably one more pump of air. The stock market is approaching oversold right now. I think it hits all those levels on Monday or next week sometime, and that's a very tradable bottom. Will we get all the way to the December lows? We might. So certainly don't catch any falling knives, right? I don't want people telling me, well, you told me to get fully invested. If I tell you to get fully invested, that doesn't mean go out and do it right now. That means scale in, right? Scale in over a number of weeks or months. In this case, it'll probably be weeks, but that doesn't mean that you use all of your dry powder either. So I have consistently told people, have cash available to invest at virtually all times. The amount of cash that you invest is directly proportional to the amount of, to the level of valuations out there in the market. So let's go back to trade. We know that China, right here, has been growing their GDP and their exports for a long time. And that's been very good for their standard of living. They've pulled literally hundreds of millions of people out of poverty. And that's good. We instigated this back in 1972, right, when Nixon went to China. And that's when the free trade era really kicked off. So all of these nations who could have been belligerent because they could have had hungry, cold people started to do trade, and they started to make money. There's no doubt that the United States has carried the global economy for decades, going all the way back to the end of World War II. The concept that we haven't been a massive force for good is silly. You can talk to any Australian, but talk to really anybody who has lifted themselves out of poverty and then backtrace where the underlying economic strength has come from. The United States has exported economic strength to nations all over this chart. So when you take a look at Asia, when you take a look at South America, when you take a look at Eastern Europe, all of these countries have better standards of living today because the United States, rather than being protectionist for the last 50 years, 60 years, 70 years, has been one of the leading free trade economies on the planet. Now, we're not at the very top. 10th, 11th, 12th, 13th, 14th, right in there. But most of the countries that are freer in their trade are smaller countries, right? So they don't have the need to protect because they didn't have much to protect. In the United States, there are key industries, defense-related, gigantic employers like the auto industry, that we have chosen to protect a little bit. Why? Because, and I will tell you this, I talk to a lot of people, and back in December, I asked them about their 401ks and investments, and they didn't know what I was talking about when I said the stock market had dropped 20%. Why is that? It's because they had their jobs, and they were making their mortgage, and they were planning a vacation, and they were paying down their debts. It didn't matter to them that there was fluctuation in their 401k and their retirement plan. Now, I know this doesn't impact many of the people on this call, but if you're in the 80% of the population that doesn't have excess cash to really ever invest, and in fact probably is still living month to month, your 401k balance is something that you hope is there when you retire. And if you lose your job, you're about 50-50 likely to cash it in so you can pay your bills. Back during the Great Recession, that's what happened. People who lost their job, about half of them cashed in their 401ks and started over, and they lived on that money for a while. That's how they kept their houses. That's how they moved. That's how they lived. So when we take a look at this, we take a look at where the United States is, we have been the fuel for all of this growth. That and the demographics that support many of the emerging economies. China had positive demographics until 10, 15, 20 years ago. India still has positive demographics. Vietnam has positive demographics. Mexico has positive demographics, right? So when countries like France and Italy and Spain, Ireland are still doing okay despite negative demographics, you have to ask the question why. And President Trump has made the point of telling these European group of allies, hey, you better figure out that you can't keep outspending your paycheck because we're not at the point anymore with our neutral demographics. Really, we have neutral demographics to support the global economy anymore. It's gotten too big. Too many people are competing with us. We're a developed economy, right? So the next great big global growth move will be whenever they decide that it's time to rebuild the global infrastructure into a sustainable alternative energy, clean water, sustainable economy. When does that come? When do we usually make massive changes? We usually make massive changes during crisis. So while we can talk about the right things to do that we should probably be doing now, we're not going to do them until we feel threatened. When will we feel threatened? During the next recession. When is the next recession? Probably next year. Why? Well, I showed you that article a few seconds ago, and I would encourage you to go to Fundamental Trends because I believe the 401k article is open to the public. So take a look at those charts. They're pretty convincing. The thing is when we have charts that say, hey, a recession is coming, that doesn't necessarily mean tomorrow, right? So trade war is heated up, and we also already had growing recession risk. we can maintain levels at the bottom of these charts for a while. How long is a while? Sometimes a year, sometimes two. This is a different chart, but same concept. So go through these, and you will find that recession risk is growing. And I link out to Understanding the Slow Growth Forever Economy, and I show the risks. So when we have something like free trade getting disrupted, we have to ask exactly how much of a harbinger is that of changes to the economy. And the answer is going to surprise you. So, one of the, if you're a South Park person, South Park, you know, the TV show, you will remember they took our jobs, right? Well, China didn't really take our jobs, not from the standpoint of reality land. About 80% of jobs are impacted by technology. So most of the jobs that have left or disappeared, right, they didn't really go anywhere, they just disappeared. Now, about 20% of the jobs that have been offshored had to do with lower wages in other parts of the world. Only about 20%. The other 80% is technology. A lot of studies that demonstrate that, and I'll show you a little bit here in a second. But the whole lower wages abroad thing is a diminishing problem for the United States and the other developed markets. Why? Because the developing markets are developing. They're becoming more developed. People are making more money. In the last decade, wages have really doubled in China. Granted, off of a low base, but still doubling is doubling. And the wage disparity between American industry and manufacturing and Chinese has gotten to the point now where when a company wants to set up manufacturing or supply chain, they're probably more likely to do it closer to the end consumer than across the ocean that requires transportation that's going to offset the narrowing labor disparity. And that's going to happen because if you build a factory here, you're probably going to automate quite a bit of it. A robot in America, a robot in China, not much difference in price, right? A little cheaper electricity here. So what we know is that worker displacement is right around 80% technology related. The trend will continue. Over the next 15 years, decade or so, and this should be updated a little bit, but this is the most recent I could find, about 15% of global jobs will be disrupted by technology. In the United States, and in Germany and other developed economies, it's a higher number. In developing countries, it's a lower number. Why? Because they still are not employing the technology as fast as companies here. That will continue to change. They will catch up. Now, question we have to ask is, as these jobs are displaced, what happens to those folks? So lower skilled, easier to automate jobs will continue to be diminished. We already know that this is in place. So you have to overlay these concepts with trade concepts. Like I said, we're going to talk about something that's very advanced economics. I'll try to make it simple. I think I have a chart that does it. We'll see. But we know that certain jobs are going to be in higher demand, right? 133 million new jobs. And then other jobs will be in lower demand, 75 million fewer jobs. So what is the takeaway here? The takeaway is that technology actually, and we have seen this, technology creates jobs. Now, they're not 60-hour-a-week, try to get overtime, sweaty manufacturing jobs. They're 35-hour-a-week, ask for that 5th week of vacation because you're going to still get all your work done jobs. And that's good. So folks who are willing to, and able, some people aren't able, but usually it's a question of willing. People who are willing to do the training for jobs that are more tech related or service related. That's why the service industry keeps growing. There's jobs out there. What is the evidence? The United States, despite some very traditionally economically questionable policies by the Trump administration, is at full employment. Certainly, the tax cuts have a lot to do with that. And at some point, we're going to have a reckoning with the mounting debt, because the federal deficit is greater today than it was under Obama. And the difference is that supposedly we have a good economy now, and supposedly there was a bad economy then, right? I think there's no supposedly. Financial crisis was a big deal. They spent to get out of it. Why are we spending an equivalent amount today when the economy is supposedly good, right? And I would suggest that all along, and I've written about this, President Trump was intent on pushing back on China, and intent on pushing back on Iran, and intent on being a little bit firmer with our allies. All of the things that President Trump is doing, he intended to do. It's not flying by the seat of his pants. Now, you may question his policy, but you can't question what his goals are. You may question his sanity. You may question his morality. But don't question that he is heading in the direction that he said he wanted to head in, and he's doing it at this point effectively. Now, does that mean it'll continue to be effective? No, probably not, because the Chinese do have the tools to push back. And we'll probably see a weaker economy next year, not only because the tax breaks are going to wear off, which is a big deal, but because China is probably going to fall on the sword a little bit. We are seeing that from President Xi right now. And I don't believe that he is of the mind that he wants to compromise. A few months ago, I did a webinar where I talked about how we would either get a no deal or a fake deal with China. There's still a chance for a fake deal where they buy a bunch of our stuff and President Trump gives in on a bunch of their demands, United States demands. But I think the odds for a no deal have grown dramatically. Why? Because President Trump wants what he wants. President Xi wants what he wants. And in President Trump's mind, he is very good at blaming other people for his problems. So, if we have a trade war with China, he's already framed it as they broke the deal. Already framed it that way. He's raising, actually, tariffs went up last night on goods that are being transported as of today. So if it was already in the ocean, it's not going to be subject to the tariff. But if you throw it in the ocean today, subject to the tariff. And he's talking about putting tariffs on everything else that China exports to the United States. So that brings up the question, what are China's ability to retaliate? Certainly they can raise tariffs on our goods and services, but they don't import as much as us. So we have a lot of wiggle room there. People will talk about the Chinese crashing the dollar because they hold a lot of our reserves, and maybe they cut a deal with Saudi Arabia to trade oil in yuan. Maybe, but if the United States suddenly has a weaker dollar, we export a lot more. That's bad for China too. Can they mess around with our debt? They could, but ultimately, we can always do the helicopter money and say, fine, we'll just devalue your debt. So China really doesn't have a lot of great tools for fighting back against the United States. President Trump knows this, but what China can do is basically induce a global recession. Will they do that? Seems like they might be willing to do it. They might be trying to put as much pressure on us as possible and stimulate back in China. And that's really what appears to be going on. The stimulus going on in China is pretty massive right now. they're loosening up on their banking regulations, and they're putting money into the economy, and they're trying to manage their stock market at the same time, which is interesting to me. So China is going to try to grow their economy without the United States. Will the populist, protectionist, China first crowd, or the populist, protectionist, America first crowd win? I think the answer is probably they both lose, but they probably both only lose a little. Why will they only lose a little? Well, let's take a look. So I mocked up this this chart here, and I think it's an important one. When did the real global age of free trade begin? Nixon's trip to China in 1972. You can see from there to here, all the way through the financial crisis, global free trade just went up and up and up and up as a percentage of global GDP. Financial crisis crashed it, encouraged corporations to focus on efficiency. What began right after the financial crisis? The age of machine learning. So after the corporations right-sized with layoffs and closing factories and everything else they had to do, we've been moving into the age of machine learning, just barely, just a little bit. This decline in global trade wasn't even under President Trump. This is under President Obama, and it's drifting down a little bit again. It'll be updated next year. So what happens in an age of machine learning when we just saw that all these jobs can be impacted by machine learning? It means that global trade can fall by a solid 25%. 25% of 55%, that's another 15, 16, 17%. Get all the way down in here. This box, if we think of it like a stock trading, and this is the breakout, come back and say, well, this looks like the normal range for the amount of trade that will impact global GDP. So that means trade can come way down as a percentage of global GDP. Does that mean that global GDP will crater? I don't think so. A lot of economists will say yes, that global GDP will crater, but I go back to the age of machine learning. If a robot in America doesn't cost any different than a robot in China, does it matter if GM makes their American cars here and makes their Chinese cars in China? Right? There will be a balance based on how much of GM's inventory gets shipped from America. What are they using for parts? Is there a back and forth on how they do the assembly? And I focus on cars because it's a gigantic industry, and it really impacts a lot of other industries. And then we have the age of autonomous driving coming upon us, where we'll probably get level 4 autonomous driving, and we talked about this recently, in the next 4 years or so, 4 or 5 years. Level 4 autonomous driving is basically, you still should stay awake, but the car is really going to do most of the driving. Level 5 autonomous driving is go ahead and fall asleep. We may or may not get level 5 autonomous driving in the next decade, but for sure we're going to get the level 4. As 5G networks come on and the 2 different types of autonomous driving systems are developed, I think one will win out over the other. And one really can't even get to level 5. So, you know, what Tesla is doing is probably what will get to level 5 eventually. But the level 4 super assisted driving, everybody's going to have that in about 4 or 5 years. So when we take a look at what machines will do for us, what technology will do for us, we have to figure out a couple of things. What industries are impacted? What kind of money are these companies going to lose or make? Right? Who is impacted by this? Who is impacted by this? And what sort of legislation might come up? Right now, in the United States, there's a shortage of truck drivers of about 125,000. But and a lot of these things are really tied together. As electric vehicles come online, the shortage of truck drivers will diminish. Why? Because a lot of the truck drivers are driving around oil. Because we've decided not to build pipelines. Even though, as I've ranted on before, one more pipeline from Canada and we don't have to deal with OPEC. But, you know, it's a pipeline. Better off to have to deal with OPEC, I guess. So what we want to know is which companies are going to do better in this environment and which companies are going to do worse. Well, first, we have to go all the way back to the idea that the market is very thinly traded right now. We don't have the underlying buying pressure of the baby boomers anymore. In fact, the baby boomers, as of this year, are in net withdrawal from the markets. And that net withdrawal is going to increase every single year going forward. The pensions are selling off. Why are the pensions selling off? Because young people don't have pensions, and so they're not putting money into the pension system. The baby boomers have pensions, and they're drawing down. Thus, the pensions must sell off 3, 4, 5% of their holdings, their equity holdings, pretty much every year, because their fixed income and cash holdings remain within a range. So as they peel off equity holdings and they lose their upside, eventually there will be a pension crisis. And I think that that is going to be the impetus of the next big crisis, about 10 years out, give or take. This next recession that's coming is going to be fairly shallow. There really isn't a lot of reason why it should rise to the financial crisis level. That doesn't mean that it won't. We're good at screwing things up, but it shouldn't. It should be a legitimate correction that we can grow out of. And it'll just be part of the adjustment of global trade being a lower percentage of global GDP. Probably getting into this box over the next 10 years. And remember, the Democrats winning in 2020, which I think is almost a slam dunk, doesn't mean that these policies will change all that much. They might be rolled back partially, but ultimately, the Democrats, a lot of them anyway, believe that we should be protecting our industries. I'll argue that those arguments don't make a lot of sense anymore because machine learning is doing it for us. So protectionism is happening because of technology in the long term. In the short term, we can push it for political reasons. We can make it out as an economic statement, but the reality is that supply chains are going to move closer to the consumers. And global trade will be a lower percentage of the global GDP. Who is that good for? That is good for nations with resources. Countries that have metals and minerals and natural gas in particular, and food really in particular, and water are going to do well. So ultimately, in the new global trade era that will emerge over the next decade, countries like the United States will do well, even though global trade is a lower percentage of global GDP. Why? Because there's nations, and I talked about this 5 years ago, 6 years ago on Market Watch, is there's nations that will need the food in particular, and the energy, and some of the metals and minerals that we have. Australia probably does very well. Canada probably does very well. Some of the South American and African nations probably do very well. The developed nations where they are running out of resources, Europe in particular, Japan in particular, and even China will struggle. Nations that have to import food and energy are going to have a problem in the next decade. They're going to keep stimulating their economies because they will try to grow out of their problems rather than facing the reality that they need to convert to a sustainable economy. How fast we transfer our economies to be more sustainable, right? Vertical farming, alternative energy, smart grids, more efficient buildings will determine who leads in the economy. The nations that transition the fastest will do the best. Trade will be secondary. But we're going to want to invest in the countries that have resources, food in particular, to export. Natural gas and food are going to be a very big deal because natural gas is going to wipe out coal in the next decade all over the world. And you can doubt that all you want, but I'm telling you, the United States will stop exporting coal in the next decade. And we'll stop mining it as well. There won't be new projects. Australia has that pressure too. I think they follow suit with us. So we should prepare for things that conservatives don't want to hear. Conservatives don't want to hear that President Trump is probably going to lose next year by 6 or 7 million votes. That would be my projection. Could be 8 or 9 or 10 million votes. I don't think it'll be Mondale bad, but it's going to be pretty bad. Why do I say that? Hillary Clinton won by 3 million. They won by more. The Democrats won by more in a midterm. President Trump is going to lose by more than the Republicans lost by in the midterms. And that's all there is to it. And in particular, if the economy slows down, which I believe it will, it'll be even worse. Then you might have a Mondale loss. And he'll launch his TV station, say we're all wrong, and make a lot of money. So whatever. As we understand that the age of machine learning is really what's driving things, that global trade will be a lower part of global GDP, and that sustainable economies will lead, that's where we're going to make our money. We want to be invested in companies and sectors that have something to do with this transition. What companies will benefit from machine learning? What companies will benefit from exporting aluminum, silver, natural gas, food, right? Which companies? How will the fertilizer companies do? How will the lean, mean mining companies after this age of consolidation and mining do? Which ones are going to be the leaders? I will suggest that it'll be the companies that have aluminum and have silver and have zinc. A little bit of gold doesn't hurt. But also have moved to improve their balance sheets dramatically. What company have we been buying a little bit of lately? Newmont Mining. Why Newmont Mining? Take a look at their profile. Take a look at their merger with Goldcorp. So now they're Newmont Goldcorp. Largest producer of gold on the planet. And in an age where many nations will just keep stimulating because that's all they know how to do, rather than engage in fiscal policy that changes the nature of their economy, gold will go up in value. Why? Because it ain't going to be Bitcoin. That's why. So people will hold on to gold, and incidentally, gold suddenly has an industrial use, right? It's being used in mobile phones. Apple has the most gold in America. They do. Apple holds the most gold in America for a corporation. Think it would be a bank, right? So you take a look at what's going on, and you say, okay, what are these two guys really doing? And I would suggest that President Xi, other than wanting to hold on to power, wants to keep his economy because he knows that they're transitioning to a consumer-led economy versus an export-led economy anyway. He wants the goods and services sold in China to be mostly Chinese. It's understandable. We're in America. We want most of the goods and services to be American. Now, at a certain level, comparative advantage does come into play. But a widget made by a machine in China is going to be the same as a widget made in America made by a machine. So the marginal differences are going to be with resources, who's got them, and who's an expert at certain things. Who's the most educated? Who understands business cycles the best? Who are the best business people? Who are the best scientists? Who are the best engineers? Corporations that can provide services around the world are going to do very well. I've been watching Fluor for a couple of years. I think at some point they have a tremendous surge in growth. I could be wrong, could be a competitor of theirs. That's the problem with that. There's other good companies. So we have to be very judicious in how we pick out our investments. So I have come up with 3 trades, and I'm not going to share them with you today. Today we're going to end it at 45 minutes. And if you are not a subscriber, you should become a subscriber. $499 a year at Fundamental Trends. You'll get that report, and you get everything else that's on the service. And I am I saw my accountant this week, so I could continue to restructure my businesses. There's going to be a lot more of Fundamental Trends. I'm going to be trading my accounts, and I'm going to be doing that in the chat rooms. So take a look at Fundamental Trends, because it's a pretty good website. And we just nailed SunPower, right? SunPower, I told everybody to get in front of, and it's up 10% today. I think it's up 10%. So we cover stocks to swing trade, what sectors, global economy, where to do hedging, which we didn't really hedge this correction because it was unknowable. And then mumbo jumbo. Basically I'm just telling you that, Bucks, Packers, and Brewers are better than your teams. But there's more, okay? So I would take a look at Fundamental Trends. I think you get a lot of utility out of it. If I can't make you $499 over a course of a year, then fire me. But the service is really going to be worth thousands. That's the goal, so I can raise the prices. So as a charter member for a couple hundred people, other than the legacy people, $499 a year. FA Trader, if you just don't have that kind of money to spend, you only want to spend $20-30 a month, go over to FA Trader. My report will be up at FA Trader Monday night, along with all my other websites. Margin of Safety Investing, if you're mainly a retiree or pre-retiree who's looking for longer term investments, go over there. You get the first year for $399 and then renew at $499. The only thing that you don't have any over there is some of the 401k services don't work on that platform, and the swing trading doesn't go on that platform. But we're going to have some really great long-term companies over there, and then all the asset allocations over there too. So, unless you're trying to hit, lots of home runs, margin of safety investing is great for you too. But FA Trader, you get 9 different analysts. Take a look at that. All right. So the rest of the report is coming. Why don't we take a couple questions, and then we will move on and have a great weekend for Mother's Day. Everyone back in the pile. Yeah, that's a South Park reference. Any thoughts on the Uber IPO? So I take a look at Lyft and I take a look at Uber, and I want to get both of those stocks at the price of the last funding round, right? I don't want to be cashing those investors out. So the last funding round at Lyft, I don't remember what it is off the top of my head, but I was looking at that. So you want to take a look at what the last funding round was at Uber and Lyft, and you don't want to pay any more than that. Occidental, I love Occidental. I think that this was an amazingly good, and I'll write about this too. I think it was an amazing, amazing takeover. Remember, even though they outbid Chevron, they paid the same price that they would have got the company for last year or the year before. So they didn't overpay for Anadarko. They just paid more than Chevron. And what folks don't realize about that merger is that a couple of things are going to happen with Occidental. The first thing is that they get multiple tiers of shale that are adjacent to where they already are. So they get scale, shale scale, and they get synergies. They're going to save $3.5 billion a year. They already made back $8.8 billion by selling the African assets to Total, right? So they had to borrow $10 billion and they made $8.8 billion back in 4 days. That's not bad, right? So I like Occidental. I think it's better than Exxon by a long shot. And I think it's a little bit better than Chevron. The problem with Chevron is they're more of a litigation target, and they have dead assets around the planet. Occidental, remember back when they developed the ports to do oil exports, and then they sold it. There's smart management at Occidental. They will sell their non-strategic assets and their non-core assets, and they're going to drop all that money to the bottom line. And then you're going to get a technology announcement from them in the next year. The technology announcement is going to be, this isn't speculation, they're working on it, they're just ironing it out. They are going to be able to do enhanced oil recovery, not only in conventional wells, but on unconventional wells. So they're probably going to be able to double the output of a fracked well for about 160% of the original cost. So basically, instead of having to, do it twice, it's 200%, right? Double the price. They're going to be able to take an old well, refrack it, and it'll be cheaper than what they're doing now for refracking. Because the enhanced oil recovery using the CO2 is a big deal. The CO2 industry business is one of the reasons I really like Kinder Morgan. Either Kinder Morgan's going to sell their CO2 business and make a bunch of money today, or they're going to grow it and make a lot of money over the next 10 years. I prefer to see the oil companies that I am invested in be very Permian focused and shedding all their other assets while other companies will buy them. So I like Occidental because they don't have the incredibly huge asset base that the majors do. The majors don't have any way to buy their stuff. Bolt-on parts here and there that barely move the needle. Occidental sells their African assets $8.8 billion, right? More than 10% of their market value. All right. SunPower, time to trim SunPower, somebody says. Why would you say that? What did I say about SunPower? If SunPower survives, and it looks like they will, they're going to go up tenfold. Why would you sell after a 10% move? Right? Trade some options around the edges. If you wanted to make a SunPower trade, you should have bought a couple calls a few days ago. Right? So, yeah, they've been trying to buy Anadarko for 2 years, and they got it for the same price they would have gotten it for 2 years ago. Yeah, absolutely. I think that the real estate market is overvalued. If you take a look at some of the reports coming out, flipping properties isn't working anymore in most markets, and we are way overbuilt on rental units. You can go to any city, anywhere in America, and you can find a cheap place to live, unless you want to live downtown. Downtowns are expensive. But other than that, man, you should see what I rent in one of the nicest suburbs in outside of Milwaukee. I couldn't buy this, but I can rent it. Why? Because people take 5, 6, 7% on their money. Whatever. It's not my money. You know, I can pay half for my living expenses and invest the rest. Now, granted, a lot of people don't invest the rest. I do. So I think that investing in rental property, you are way late on that, bro. Wait for the next recession. And I will say, I think that we are, if we had to correlate what year we're in to the Great Recession, we're in 2006 or 2007, probably 2007. The difference is that the recession ain't going to be that bad. Shallow recession, it'll scare people. People who haven't prepared by saving money are going to get soaked. 10% of the population is going to cry. Why? Because they didn't get educated, they don't have good jobs, you know, and they're unlucky. And you're going to have to help them. You're going to need to help your neighbor. If you're on this call, you're going to have to help a neighbor someday. Accept it. Prepare. Be nice. It's going to happen. Yeah. So between Occidental and SunPower, I love them both. I probably will add to my Occidental position, to be honest with you, and I'll trim something else on the next oil rally. I do want to try to get rid of all of my oil leverage sometime this year, because I do think that we're going to see a vacillating oil market, but I don't think it's going to do what it did last year, just because if you have taken a look at what's going on in the Middle East, that war that I said was coming 16, 17, 18 months ago that will involve Iran, we're there. You know, we're sending carrier groups and amphibious units to the area. Iran is pulling back on the nuclear deal. Something bad's going to happen over there. Yeah, Sierra Wireless, another company we're in. You know, I don't know if people break it out this way, but I do. I break it out by sector. If you throw out our oil investments, which has sucked on and off now for a couple of years, we've crushed the market. If you had the idea that, hey, I like everything he's saying, but I just don't trust the oil thing, you probably tripled your money. So, you know, once we get back to go on the oil, which I think we will, then we have to understand where the economy is going. We have to convert our portfolios into sustainable growth and income vehicles. So I don't look at oil as a very long-term investment. And natural gas will just be a short transition. Everything that's impacted by the age of machine learning and the transference to a sustainable economy over the next decade is what's going to lead. That doesn't mean there won't be some good investments outside of that. It just means that this is where we're going to find, in these secular trends, the biggest winners. So, something that Zacks taught me. So I subscribe to Zacks. Their high-end service. I pay a lot of money for it. And I took a look. Remember I've told you that you only want to be invested in 6 or 7 sectors of the economy? You don't want to be in the S&P 500. You want to be in about half of the S&P 500. Zacks put out a statistic. If you invest in only the top half of the sectors, you'll make 80% more money than if you invest across the index. So if you're picking out 6 or 7 sectors, and even if you get a couple of them that, you know, get below the midpoint, but you generally get the fact that technology is always a leading sector, and that consumer discretionary is generally a leading sector, except going into recessions, you're going to make money. And real estate too, except going into recessions, right? Everything's going to suck going into a recession. But what's going to come out of it? Technology, real estate, certain resources. You know, that's what we want to focus on. Consumer discretionary. You know, eventually that becomes very apparent to old investors. Ignore the crappy parts of the economy. Now, I will say, I don't know where to put utilities right now. I thought utilities were going to get crushed, but they are adapting so rapidly to the alternative energy. You know, this utility in Indiana tearing down a coal power plant to build solar and wind with batteries. That's Indiana. I mean, that's not even in the desert. So that change is coming a lot faster than we think. And the paradigm shift on oil, which I anticipated, I just didn't think it'd be as fast and as brutal as it's been. You know, that means that we have to escape from that market eventually and move into the other things. But the trade, it'll create volatility. We can trade off of that. We can establish positions off of that. And it will probably cause a small recession next year. That with the wearing off of the tax breaks. Now, they're going to end quantitative tightening in September, so that'll be positive for the economy. So you have positives and negatives. President Trump is using the positives to change the economy to the way he thinks it should be changed. You can agree or disagree that he's doing the right thing, but don't doubt that that's what he's doing. And he's pushing the envelope with Iran, which I've always been a hawk on Iran. You know, I love the people, but their government's got to go. So we'll see. I would encourage you to watch the Monk debates. You know, I'm a pretty liberal guy in a lot of respects, but they're very tilted liberal and almost apologetic to the Chinese. I don't think that's the right way to look at it. I was very impressed with H.R. McMaster, and I would try to track that down. The Monk debates, the one with H.R. McMaster and Singapore, what I think is a bought and paid for academic. You know, so take a look at that. All right, anything else, or can we trim? Take products out. No, I wouldn't be trimming SunPower. I've told you that twice now. I would not be trimming SunPower. If you want to sell some covered calls, $1 out of the money, or $2 out of the money for, you know, half of a position or a quarter of a position, then fine. But you know, unless you're a very, very good day trader, I don't, and we don't really do that. We do swing trades. I just don't think that something that you think is going to go up 5 to 10 fold, I don't think you trim it on a 10% gain. If I had been trimming my exact sciences, I would have never made $1 million, right? So, you know, you want to hold on to stocks that can be big time home runs. CenturyLink, very valuable assets. I don't think they're ever going to reduce their dividend again, but I don't know when they show the growth and pay down of their debt to really get investors interested again, and that's the trick, right? They either got to get bought out or they got to get investors interested again. And I don't know what they can do to make that happen. So am I holding on to my CenturyLink? Yes. Am I expanding my holdings past 2, 3, 4%? No. You know, I look at it as a long-term hold because, I mean, over the course of a decade, you're almost going to double your money on the dividend. So even if the stock never goes up, you know, you're doing okay. But I think there's catalysts for that stock at an unknown time to go up. And you just don't want to blow up your asset allocation, because what if technology really does blow them out? Could happen. And I think that their fiber optics are very important, and I think their enterprise business is very saleable. You know, I think the fiber optics and their enterprise business, you know, they could sell both of those and then just, you know, wind down the wireline business over 100 years. I think it's too late to short Lyft. Already got its butt kicked, right? They're almost down to the price of their last funding round, so look that up. Look up Lyft and Uber's last funding rounds. I don't think we want to add Intel yet. I think they have another kick in the teeth coming next quarter. But, you know, I really liked Micron in the low 30s. What is it now? Still like almost 40, isn't it? I think it's in a trading range. It gets down to 32. I'd be an outright buyer. You can sell puts now down to about 34 if you wanted to. But I think Monday, take a look at what's happening Monday. You know, we might get a big time down day on Monday, and you know, first couple hours of Monday might be when you want to sell your puts. Maximum volatility, close to bottom prices. Yeah, let me work on that. But yeah, I don't think there's anything to do this afternoon. Go out to the garden, hang out. That's what I'm gonna do. I'm gonna go to the garden. Then I'm gonna take my girlfriend out for birthday dinner, and her mom flew down from Phoenix, so I get to meet the mom. Get to meet the girlfriend's mom tonight. See how that goes. All right. Yeah, me and a couple other people have been looking at TA. So it seems like there's hidden real estate assets there. Travel Centers of America. Speculative, not really for the margin of safety crowd, but maybe for other folks. What is the best way to raise more cash today? I don't know. Take a look at some of your losers and decide if they're going to keep losing. And if something's going to keep losing, get rid of it. That was one of the lessons from Bob Savage back at that Traders Expo. If you think it's going to go down, sell it. You know? So I have become a very big proponent of ride your winners. I mean, I always have been, but ride your winners, cut your losses quick on your losers, but make sure it's not just volatility that you're selling. Make sure that you evaluate the companies and the sectors that you're in and say, okay, have I made a mistake? And I'll tell you, I think one of the easiest places to trim is if you own REITs, trim some REITs. I think that may be where the most risk is going forward. All right. Take care. Have a great weekend.